Right now, global energy markets are experiencing intense volatility. Governments across Europe and Asia are calling emergency meetings, and financial institutions are bracing for the worst as tensions escalate across the Middle East. This map illustrates the exact geographic source of that anxiety, the Strait of Hormuz. Every single day, roughly 20% of the world's oil passes through this single, narrow channel. The universally accepted assumption in financial circles is completely straightforward. If a conflict forces this choke point to close, the global economy faces immediate, total ruin. Yet that terrifying consensus relies on outdated information. The panic is based on a version of the global economy that disappeared 2 decades ago. To understand why, we have to look back 20 years. In the early 2000s, the United States was highly vulnerable to foreign supply disruptions because it imported roughly 60% of its total petroleum consumption. This chart tracks that era. When Middle Eastern oil supply dropped, America's consequence was linear, an immediate spike in inflation and a stalled economy. But today, that correlation is broken. Modern shocks are asymmetric. The impact depends entirely on your side of the trade. A closure of the strait today does not result in shared global devastation. It creates a stark, immediate divide between massive economic winners and desperate losers. The catalyst that severed American dependency was a breakthrough in drilling technology. Advanced techniques allowed for the extraction of resources from domestic shale formations that were previously unreachable. The United States is the world's largest oil producer. Only 2.5% of oil flowing through the strait reaches American shores. A tight global supply creates a price problem at the pump, but America's physical access to fuel remains completely intact. And those soaring global prices carry a counterintuitive benefit. When supply disappears elsewhere, domestic producers step in to sell at a premium, generating record windfalls for massive American energy exporters like Venture Global and Cheniere. So for the United States, a Middle East supply shock is frustrating at the gas station, yet it structurally stimulates and enriches the broader American energy sector. Most Middle Eastern oil flows eastward. China, India, Japan, and South Korea absorb 75% of the strait's supply. China is uniquely exposed. Its economy requires an influx of 11 million barrels of foreign oil every single day just to function. Beijing anticipated this vulnerability. For years, they have been stockpiling physical strategic reserves, building vast storage networks to buy themselves time in the event of a blockade. But time eventually runs out. When those reserves are drawn down, China transitions from facing a financial inconvenience to a terrifying supply problem. Higher prices are a drag. Zero physical fuel means rationing. Without physical supply, the core of the economy begins to break. Manufacturing centers lose power, heavy assembly lines grind to a halt, and industrial output inevitably collapses. Now, zoom out from energy markets and observe the timing. This escalating tension in the Middle East aligns perfectly with a critical phase of trade wars, tech restrictions, and supply chain decoupling between the United States and China. High-stakes superpower negotiations rarely prioritize diplomatic compromises. They operate on the mechanics of pressure, seeking out areas where one side holds an undeniable structural advantage. The asymmetric energy shock provides exactly that. The United States can tolerate a market event that would systematically devastate China's industrial base. When one side can endure a crisis that breaks the other, the crisis itself becomes a source of leverage. The Strait of Hormuz has evolved. It remains a physical bottleneck for oil, but it has also become a strategic pressure point. As long as China's economy requires the flow of this energy to survive, its reliance on the strait remains a structural vulnerability the United States does not share.